I appreciate you all being here today, ladies and gentlemen. Logic is more important than emotion, and this is a principle that has shaped my thinking throughout my life. One of the most important stories of our time is unfolding right now: the extreme strain on a monetary system that is being fueled by debt. Having actual, non-debt backed assets is not only wise, but may be crucial when you take a step back and look at the situation objectively. Now more than ever, the world's financial markets and the very basis of our monetary system are under jeopardy due to a debt cycle that has grown beyond sustainable limits. The evidence from history and mechanics is strong when seen objectively. The long-term debt cycle is nearing its end, and the danger is now very much with us. Debt has increased at a far faster rate than economies can afford to pay it back, and this is the root cause of the risk. A lot of people feel like we're riding an endless wave of prosperity because credit expansion has fueled growth, driven asset prices higher, and created that feeling. But that wave is literally riding on the coattails of a previous one. All other forms of government spending, investment, and social programs are coming under increasing pressure as a result of the ever-increasing interest payments and other costs associated with servicing our growing mountain of debt. It's similar to an artery with an excessive amount of plaque. At some point, the flow becomes blocked. The growing problem that governments are confronted with is the increasing cost of debt service. To make these debts more bearable, they will need to either raise taxes, reduce spending, or implement austerity measures. Printing more money has been a typical solution in the past. Do not mistake this for a conspiracy theory. Instead of the politically and economically disastrous default, it's the simplest option for a country that owes more than it can pay. It is common practice for central banks to intervene, devalue the currency, and monetize the debt. The devaluation, however, does not come cheap. It penalizes creditors, diminishes the purchasing power of money, and hits individuals with fixed income promises the hardest. Borrowing and subsequently monetizing is not an innovative mechanism. This is where the cycle of long-term debt begins and ends. Prior to the credit-fueled boom, when borrowing seems easy and returns appear generous, there is the sound money phase, when debt is low and assets are valued conservatively. When the load becomes too great, interest rates rise, and faith in the system dwindles, we reach a tipping point. Debtors face difficulties, financial stress increases, and central banks step in during that stage. Restructuring and default are not uncommon occurrences. Devaluation and inflationary pressures result from the printing of money more frequently. The fact that we are not merely discussing the debt of one country adds further uncertainty to the present scenario. The world's most important reserve currencies are themselves facing challenges in this system. The amount of debt backed by those currencies, particularly the US dollar, has grown substantially. Concurrently, central banks are holding massive balance sheets. Borrowing is inexpensive and real yields are low. An unstable dynamic is produced by these processes. At a time when supply is surging to cover maturing obligations, demand could collapse if foreign investors lose faith in sovereign debt. In a situation where supply exceeds demand, interest rates need to climb to entice buyers. However, this strategy backfires because higher rates make debt servicing more expensive, which exacerbates the original issue that caused the risk. Policymakers are faced with a clear decision at that precise moment. Opt to let interest rates rise and face painful restructuring, or print money, monetize the debt, and accept currency devaluation as a result of your intervention. We learn from past mistakes that they frequently opt for option 2. Why? A default is a political minefield and a major pain in the neck. Although printing money while inflationary may seem like the easier option, it actually has consequences. A flight into hard currency, or assets with tangible real value, can occur in the most severe instances of inflation, which eats away at savers' purchasing power and erodes faith in the currency. But creating more currency won't solve every problem. When the depreciation of currencies happens too quickly, people start to lose trust in the system. They seek out substitutes that they might use as commodities, hard currencies, real assets, or other forms of value storage. Because the promises are now measured in units that are losing purchasing power, the value of debt assets is eroded by this flight. The real cost of the underlying debt burden has been concealed by inflation, but it is still there. As time goes on, the delicate balance starts to wobble. The political dimension adds insult to injury. There are varying causes of debt crises. Deeply political, are they? Living standards may remain unchanged or even fall if debt loads increase. Anger increases. There is a rise in populist demands. Cut spending, which is unpopular, raise taxes, which is divisive, or keep monetizing, which is inflationary. Leaders face difficult choices. Both currency depreciation and redistribution become alluring levers. Governments have used a combination of austerity measures, reorganization, redistribution, and money printing in numerous historical episodes. Beautiful deleveraging, a mix of stimulus spending, fiscal restraint, managed inflation, and reforms to revive the economy, is one possible way forward. Debt reduction without catastrophic default or hyperinflation is the aim, but getting there is no easy feat. Credible policy, which is becoming more scarce in the face of geopolitical fragmentation, growing inequality, and changing power dynamics, as well as disciplined coordination, are essential. A debt death spiral, devaluation, interest rate hikes, revenue losses from debt servicing, money printing, and other policy failures are all possible outcomes. Looking at past crises through the lens of an investor reveals precisely that kind of self-reinforcing loop. We must pay attention to this macro risk. Default risk is only one aspect. Issues of systemic resilience, currency risk, and inflation risk are at stake. Some people may be mistaken in thinking that holding only debt or cash will keep them safe. Even though taking out a loan might seem like a good idea when money is cheap, the actual cost could end up being much higher than it seems. It is critical to comprehend the beginning, peak, and unwinding stages of this cycle. You are taking a risk assessment wrong if you think we are still far into the cycle. For this reason, it is essential to consider diversification, exposure to non-debt assets, and safeguards against currency depreciation in addition to the traditional portfolio considerations. We are at a point of structural weakness. The massive amount of debt is a problem in more ways than one. A potential shift in the playing field could be caused by this monetary and macroeconomic risk. It will take careful navigation and an awareness of the interconnected nature of money, debt, and credit if we are about to embark on a new deleveraging phase, or worse, a debt spiral. We err if we disregard the fact that history does not repeat itself in a perfectly consistent fashion, but rather according to patterns that rhyme. When you give silver some serious thought, its hybrid nature becomes apparent. It is more than just another industrial byproduct or an artifact of monetary history. It is at a unique and powerful crossroads, connecting monetary value with practical applications, serving as both a store of value and a tool for actual tangible work. In a world that is becoming more and more delicate, dynamic, and unpredictable, silver's dual nature is what truly sets it apart. Throughout history and many cultures, silver has played an important role. Money was made out of it. The fact that it was physical, widely recognized, and unencumbered by debt or credit gave it value on its own. Its impact endures to this day. During economic downturns or debasements of currencies, silver can serve as a non-fiat anchor, protecting purchasing power apart from the guarantees of fiat currency. Its physical nature makes it immune to the dilutive effects of fiat currency and unregulated credit expansion. Due to its monetary properties, silver can serve as a real hedge in times of declining faith in currency, in addition to being a speculative asset. But that's not all there is to silver's tale. Silver, in contrast to gold, which is mostly kept in safes, can be used in various ways. Its uses in industry are central. They are at the center and are expanding quickly. Innumerable contemporary technologies rely on the metal due to its unparalleled electrical and thermal conductivity. Silver paste creates conductive pathways in photovoltaic panels, which are essential to the solar energy revolution because they efficiently collect and transport electrons. There would be a decline in conversion efficiency if those solar cells did not contain silver. Here, silver is not considered a luxury good. It's essential for practical purposes. Printed circuit boards, touchscreens, flexible electronics, semiconductors, and the ever-expanding Internet of Things are just a few examples of the many high-tech electronic devices that incorporate silver. The unseen workhorse is silver. Its low-resistance conducting capabilities lead to improved performance, increased reliability, and reduced energy loss. The fast development of 5G, data centers, and electric vehicles is driving a structural increase in the demand for silver. Because of its resistance to corrosion and ability to maintain its integrity under high temperatures, silver is a popular choice for use in soldering and brazing alloys, two processes that reliably join metals. In the medical field, silver is useful for wound dressings, medical devices, and even some surfaces due to its antimicrobial qualities. Silver is not readily recyclable or reintroduced to commodity markets due to its consumption by industrial uses, which incorporate it into items such as solar panels, circuits, and medical devices. In all likelihood, silver remains in a cell or circuit for quite some time after integration. It is vital to have that physical consumption that is dynamic. As a result, industrial demand actually reduces the supply of silver rather than adding to it. As a result, the supply-demand balance for silver is altered. Even though new mine production is increasing, the available pool of silver is effectively reduced when more of it is used up in industrial processes on a consistent basis. Investors and the big picture are both greatly affected by this tightening. Because the base demand for silver is always going up, its value isn't as susceptible to market fluctuations or speculation in money. Silver can react to macro risks due to its monetary qualities. Silver provides more than simply industrial utility in times of monetary instability or aggressive balance sheet expansion by central banks. It also serves as a store of value. When demand slows for industrial commodities, their prices fall. Silver, on the other hand, has a demand-based resilience that is based on its monetary appeal. And even if the economy takes a nosedive, its dual function makes a pure industrial slump less probable. From a risk management standpoint, monetary demand can step in and hold silver as a hedge against future infrastructure, underinvestment, and macro-monetary dislocations. Materials that are both plentiful and practically irreplaceable are required for a global shift to renewable energy and electric transportation. The continual structural demand stream is created by the inevitability of solar expansion, the proliferation of electronics, and electrification, all of which fit that description. Silver, in particular, fits that description. As a real asset with strategic value, as well as a speculative asset, silver is protected by that demand stream. Additionally, production of silver is not as sensitive to price increases as one might anticipate, since a large portion of the supply comes from mining for other metals like zinc, copper, or lead. Given the limited recycling options for many of silver's applications, rising industrial demand and its monetary role can result in long-term deficits. The dual value effect is magnified by such a supply structure. There is a structural and sticky demand. There is a ceiling on supply growth, and when people are strapped for cash, demand can spike quickly. Silver basically is an asset with two engines. Monetariness is one engine, the conventional intrinsic worth that safeguards against monetary debasement and systemic risk. The second one is industrial, which is driving innovation in renewable energy, infrastructure, and technology for the future. When those engines are combined, the result is more than just a commodity. An investment and a hedge in one strategic asset is what you get. Because of this, silver is very attractive from a long-term viewpoint. Since it serves a practical purpose, it is not just theoretical. Because of its continued monetary worth, it is more than just a commodity. Due to its duality, silver may experience multiple macro tailwinds as the world's trends change, whether that's due to an increase in green energy, persistent technological advancement, or monetary instability. Silver should be included in a future-proof, risk-aware portfolio, not only for speculation, but also to protect wealth, mitigate currency risks, and take part in the tangible economic transformation taking place in our country. The fact that silver can double as a doorknob is no coincidence. That quality unites it with history and the future because it is essential to its very nature. So, silver isn't some antiquated metal with no practical use anymore. Legacy and practicality come together in it. The mix of its monetary value and industrial indispensableness is what will most certainly ensure its continued relevance and value for many years to come. When it comes to long-term financial risk management and investment, the notion of diversification is fundamental. Spreading your investments out isn't just advice for risk-averse people. Putting all your eggs in one basket is like ignoring reality in this world of complicated, interdependent economies where debt levels, monetary policies, and geopolitical tensions change at a dizzying rate. Due to the inherent unpredictability of the market, not even the most meticulous predictions can guarantee success. So, it's not a choice. You must safeguard yourself against various outcomes. This is crucial. Stocks, bonds, commodities, real estate, and cash all react differently to the same forces. And diversification works because each asset class has its unique risk-return profile, correlations, and responses to macroeconomic shocks. When one asset's performance drops because of, say, a credit crisis or increasing interest rates, another asset's performance might soar because those events have different drivers. Having a diverse portfolio makes it more resilient to market fluctuations. Managing the risk of catastrophic loss while capturing long-term growth opportunities is more important than necessarily maximizing short-term returns. Diversification is more than just spreading money around among different assets, which is a crucial but often overlooked point. Equally important is the ability to spot unequal chances. When the possible benefits much exceed the possible drawbacks, or when the risk is well-defined and controllable in relation to the possible gain, this is called an asymmetric situation in finance. While asymmetric opportunities are uncommon, they can greatly affect total wealth accumulation if properly identified and capitalized upon. Consider alternatives to the more common stocks and bonds, which can exhibit a different pattern of behavior when invested in. Precious metals, specific commodities, and specialized real estate can act as both growth drivers and hedges. Supply restrictions, technological adoption, industrial demand, and monetary pressures are often the driving forces behind their performance, rather than the traditional financial system. To hedge against macroeconomic shocks while maintaining the chance of substantial gains, it is prudent to allocate a portion of capital to assets driven by these factors rather than the market as a whole. To grasp absolute risk, one must be familiar with the idea of asymmetric opportunity. Without adequately considering the repercussions of unfavorable outcomes, many investors assess opportunities solely based on their prospective returns. The emergence of true asymmetry occurs when the downside is contained, managed, or comprehended, while the upside is substantial and frequently unbounded. Building a portfolio around this guiding principle calls for persistence, investigation, and self-control. This is not about taking risks on random occurrences, but rather about identifying patterns where certain outcomes are more likely due to the combination of leverage, systemic conditions, and probability. By spreading money out over different unrelated assets, diversification makes asymmetric opportunities work more. The ability to take measured risks in asymmetric opportunities with higher potential returns without endangering overall stability is a direct result of your reduced exposure to any one source of risk. This becomes even more crucial when the economy as a whole is experiencing macroeconomic uncertainty. Unexpected increases in correlations between conventional assets and the breakdown of hitherto secure risk assumptions can occur in times of high debt, aggressive monetary policy, or escalating geopolitical tensions. A buffer is provided by a diverse portfolio that includes asymmetric exposures. As a result, it lessens the impact of negative outcomes and stressful situations while keeping the door open to the possibility of positive surprises. The mental health benefits of diversification are undervalued. Investors often make ill-considered choices when they are under duress, and market volatility adds to that stress. Because a diversified portfolio is more resilient to market fluctuations, its holders are better able to keep their cool under pressure. Just as crucial as analytical rigor is emotional discipline. Intelligent risk management in a portfolio lets investors ignore short-term fluctuations and keep their sights set on the long haul. Time, liquidity, and horizon are other important factors to think about when trying to achieve asymmetric opportunity and effective diversification. Not every asset can be quickly converted into cash, and not every opportunity presents itself in a way that can be immediately capitalized. Investor liquidity requirements, the possibility that systemic shocks may derail typical market behavior, and the time it may take for specific positions to produce results are all factors that should be considered in a well-structured approach. Maintaining a healthy equilibrium between these elements strengthens the portfolio and makes it easier to take advantage of asymmetric opportunities without exposing it to uncontrollable risk. In addition, diversification does not necessitate strict categorization. Always keeping an eye on valuations, correlations, and macro trends is essential to this ever-changing process. The relative performance of assets will change due to factors such as rising global debt, changing inflationary pressures, and the impact of technology on various industries. The efficacy of a previously reliable hedge may decline, while a hitherto unrecognized asset class could present an unequal opportunity. A resilient and opportunistic portfolio can be maintained through active evaluation and disciplined adherence to risk management principles. The goal of a diversified, asymmetrically opportunity portfolio should not be to maximize return in a single year. The ability to weather economic storms and recover stronger on the other side is central. It acknowledges the interconnectedness of markets, the complexity of risk, and the fact that investors can best protect and grow their wealth by positioning themselves to profit from growth and protection at the same time, by combining assets with low correlations, by hedging against changes in the macroeconomy, and by taking positions that offer asymmetric upside. In the end, there is a profoundly simple lesson to be learned. Both the world and its future are complicated and full of unknowns. Embracing diversity and actively seeking out asymmetric opportunities is not an attempt at perfect accuracy in predicting the unpredictable. Instead, one is building a system, a portfolio that can weather storms that would wipe out less robust strategies, take advantage of favorable circumstances, and ride out volatility. This strategy is more than just a tactic. It is based on principles, history, and logic. The financial world can be navigated with foresight and resilience with this fundamental framework. The point of investing is not to gamble. The key is to be well prepared. A kilo of silver is not a bet on speculation right now. It's a deeply held belief based on knowledge of economic theory, the nature of money and debt, the dynamics of various industries, and the psychology of investors. That imbalance is corrected, frequently with force, is the one thing that history teaches us. I hope this has inspired you to give some serious consideration to assets other than debt. Consider purchasing 1 kilogram of silver, not because it's on fad, but because it may prove to be a powerful tool for wealth preservation in a world where traditional currency may become obsolete. I appreciate it.